Okay, welcome everybody. This is Hubert here from Trading Strategy Guides. Can I first of all get a confirmation that you can hear me and you can see my screen? Just write into the chat window, please. That would be good. Okay, so far I haven't got... Oh yes, cool. Great. Getting confirmations. Perfect. Thanks for that. Okay, so I would say let's get started straight away. Okay, so just introducing myself briefly. My name is Hubert Miranda. You've got a picture of me here on the screen. I'm a full, and I've got together with Trading Strategy Guides to provide some good quality education for you guys. And today's webinar will be about a strategy called the Big Three, which is basically a moving average based system. And I'll show you all the ins and outs, and there should be room for off-topic questions also, and we can have a look at charts of any particular markets that you're interested in. So yeah, that's me. You can, if you're interested, you can follow me on my Twitter handle, which is Miranda_Hubert down here. And so yeah, basically that's what we'll do. We'll cover the strategy, and I think there should be, because it's a fairly simple strategy in its essence, so there should be room for any other questions you might have. And so just type them in, and if anything's unclear along the way, just type that in as well, and I'll check from time to time and answer those questions as well. Okay, so I'll switch you over now to the charts. Great. Okay, so basically today's strategy is called the Big Three strategy because it's based on 3 moving averages. And as you can see here on my chart, these red, green and blue lines is what I'm talking about. And what we're trying to achieve is we're trying to come up with a way to define a trend and then enter at as and when prices pulled back somewhat, so that we get a better entry. So this is really all the strategy is about, is how do you find a trend, how do you define a trend, and where do you enter then? Can I get perhaps a rough idea of how many people here are kind of completely new to trading? How many people have some experience? Like, does everybody know what a moving average is, for example? Just so that I get a sense of where to start really with my explanations. So if you type in, some of you, if you could just type in what do you know about moving averages, how new you are to trading, that would be helpful. Okay, so I've got quite a few people with some experience. That's good. One person is new. Okay, great. That gives me a good idea. So most people know the basics for those who are completely new, I'll just quickly show you how you can get these indicators onto your chart, these moving averages. So I'm using the MT4 platform. All you do is you go onto the symbol here, which is your indicator options menu. You go to trend, and then you find an option called moving averages, and a window like this pops up. And for this strategy we use three. So we use the 20 EMA, we use the 40 EMA, simple moving average, not EMA, and an 80. And basically all that means is that basically each of these lines plots an average price value based on a certain amount of candles of the past. So the 20 moving average, this red line, takes the last 20 candles and averages them out and gives you then a spot here on the chart. Whereas this green line averages 40 candles, which is why, of course, it's lagging behind the red one. And the blue one uses 80 candles as its average. So that's how they come about, and this is what it's called here the period. So it just simply says how many candles you want to average. And the reason why you want to use different kinds of averages is when they're smaller, like 20 or 40 or so, they're quite short-term indications of the price average, and if you go bigger, like 100 or 200, you get much more longer-term averages, and they can be together quite useful to gauge as in where price is at within the bigger picture. And so we're going to use them just to get a sense of the flow of price, of where it is, because basically relative to moving averages, if price is above or below them, you can consider price to be possibly at the moment at a peak, then where it might not be the best time to buy. If they're like stretched out and price is way above the moving averages, it's not necessarily the best time to buy, because the price will always tend to come back to the average before it makes another decision whether to continue in the same direction or break through it. Okay, so just to give you the numbers again, the blue one is 80, simple moving average, the green one is 40, and the red one is 20. So I've talked about the period here. Here under method, you just select simple. There's some other options, but don't worry yourself too much with it. Just keep it simple, and you could keep the apply to as close. That's fine too. And then you just choose your colors here. So I've chosen those red, green, blue, so that I know basically red is the fastest and green is in between red and blue. So that's how I just did it for me, but you can choose any colors you like. Okay, so now that we've got that sorted, we have to think about how do we decide if something is trending or not. And within the strategy itself, the way the strategy itself defines it, which is quite a simple way, and I would also add a few maybe other elements to it, which I'll talk about, but just to give you the essence of the strategy itself, it simply means we consider things trending, like here, for example, in an uptrend, once all the moving averages are aligned in the right order and price is above them. So what I mean by moving averages are in the right order is you can see these lines are crossing over each other here. And the reason for that is because the shorter moving average, so the 20 EMA, will be more responsive to price than the larger moving average. And that's of course because uses less candles to plot its average value, so it will respond quicker to when price moves. And so hence, once you have them in the right order, as in the fastest, above the second fastest, above the slowest moving average, then you know that price is beginning to be stable enough above the moving averages in this case to consider that trend might be starting. So this is the main, first of all, the main key you need to watch out for, but I would actually recommend that you start one step earlier. Hang on, I just got another question here. Oh, no, okay, so in terms of time frames, I'll get to that, which is actually what I'm going to talk about now. So what I think you want to always start to do is look at the bigger picture. So even if you're going to trade on smaller time frames, you want to start on a bigger view, like say, for example, the daily chart, because the bigger time frames, the bigger structures will always dominate what's going on the smaller ones. So if there is a good trend on a bigger time frame, that's already much better for you than just looking on a smaller time frame and not knowing what's going on the bigger picture. So look at a bigger time frame and try and figure out whether a market is trending or ranging. And that's quite important, because when a market is ranging, the moving averages become very messy, because the price keeps on moving up and down through the moving averages, and they become less significant. So it's important that you find something that is trending. So for example, here the euro against the Australian dollar, you can see it's been trending upwards for quite some time throughout the whole of 2017 and this year as well. So you can say overall, yes, we are in an uptrend here, and so that's maybe in a way your first starting point. In addition to that, however, obviously you can see that in spite of a trending, there are phases when it gets quite choppy, like here. So you kind of, that's then when we're going to zoom in and look at what's happening on a smaller time frame within these candles more closely. But get yourself that bigger picture first of all, and also, you, just because a trend is established doesn't obviously mean that we know exactly how long it will last and how far it can go. And a key to bear in mind is horizontal support and resistance levels. So this is just simply price levels that have to do with the historical past. So I've zoomed out quite a lot now on the daily chart. And you can, for example, start to just look at tops and bottoms, significant tops and bottoms in the chart. So, for example, you can see we had two very significant touches here. It overshot here a bit, but that's okay. The minute you find places where, I'm not going even to the weekly chart, the minute you find levels that have where several candles end pretty much at the exact same level, you can be sure that it's an important level. And it doesn't matter if price like here breaks through it or so, they still remain significant. And so if I now zoom, go back here, you can actually go really far back in the past and do that. And just plot these out. Like, so here's another one. And then, of course, you can come back into a slightly smaller time frame. Oops. And see how that line here, which I just drew from these bottoms many years back, how that level is still relevant now in the last few months of trading as well. How all these wicks here, they've respected that same level. So that's how you want to kind of do a bit of this support and resistance sleuthing, so that you get a sense of when might I run into significant trouble, as in when does the trend run into significant trouble of really being able to continue. And you can see with this line up here, for example, that we are approaching now within this trend a level that is pretty major, and we should probably, and in a way we've kind of hit it already a bit at that last high. You can see how here this top is starting to get into this area anyway, but here these 2 points haven't even been hit yet. So we can say, all right, there is some room potentially still for this to probably test this out again before we might see another reaction down. So you can always expect, when price approaches a significant level like this after a big gap, so obviously we hit it here, then price went quite far away from it, and now it's approaching it again. So whenever there's a reasonably big gap between the hits, you can expect a reaction to happen. It might break through that level, but it will initially, with almost 100% certainty, show a reaction at least. It might not go down hugely if it wants to break through, but you do have to be aware if you're going to trade this on smaller time frames. So if you would want to consider buying this currency pair somewhere in here, that you should expect a price not to just breeze through this level as if it's not there. So so this is very important. Now you can then go into a smaller time frame, and I went down to the 4-hour chart and do the same here. So say we want to take this more on a short term, say maybe 15-minute chart or so. I would still check this out on the 4-hour chart and do the same here. So we've got another level here, because we've got a touch here and a touch here, and here see another, that candle also got showed a reaction to it. And that's how you go along. You just map those out. So you've got some kind of what do you call them? I guess targets in a way, you know. So these levels, they also become your targets of any trades. And look, you can see how different time frames will obviously reveal a different picture, because if I show you this chart again on the 15-minute time frame, you can see, okay, yeah, here trending now. Moving averages are aligned to the upside, price is above it, but obviously the picture looks quite different on the 4-hour chart, because this bigger uptrend that we've been in, if you remember from the daily chart, has gone into this slow, choppy sideways correction that's sloping downwards. So, and that's why you can see how the moving averages here, they were nicely spaced out, and then they started to come together and cross each other even. And now it's kind of really one of the first times again the price has managed to break above them again. So in a way, it's quite a good time to possibly come into new buy positions, because it's kind of quite helpful after a big trend like this. So we know the bigger picture is there is an uptrend. We know that this line up here, I might make this a different color. I might make this black. We know that this black line is kind of our main overall target, overall resistance of the bigger picture, where we shouldn't expect price to go much further than that, initially at least. So that's fine. Slightly smaller time frame, we see price has gone into some correction, and now it's breaking above it again, and we've got this room to the black line potentially. So that to me then makes quite a good combination for a potential buy trade. Just a little side note, you can, for example, also see if we draw a trend line like this. So I'm drawing a trend line based on this point and this point and this point in a way as well. And you can see how price here back that downward trend line again, and now it's broken through it. So that's always quite an important sign when within a bigger trend. So if I show you this again, bigger picture uptrend, correction, and then we get a break like this off that correction trend line. That's often a very good sign that we're starting to head for new highs. So now that we've got this, we can go back to our smaller time frame. So in this case, the 15-minute chart. You can see here, this is the trend line that I had drawn on the higher time frame. And you can see there how the moving averages are now really stretched far apart, because this has suddenly yesterday moved a lot of pips in one go. So the next point of the strategy will be to say that in essence you need to wait for a whole candle to close above all of the moving averages. So in this particular case, for example, here would have been the first candle that's close above the moving averages, but you can see they weren't in alignment yet. So it's really only from this point, when basically red is above green and green is above blue, that you can consider sort of taking some candles. So you could say this might have been the first candle, but because we're already in a correction, I would again then do the same thing, sort of draw like in a way a little mini trend line. And then I would say maybe this candle here with this that had quite big wicks in both directions, that's perhaps the first one to where you can say, okay, it's closed fully above the moving averages, and it's also broken that correction trend line. So that could be, for example, the first candle to say this would be a buying signal. So in the strategy, then you not only wait for that. This is just your first gauge. You would actually wait for that to happen, and then for some retracement. Now in this case, there wasn't a retracement. We just kept on going up. The first candle that was showing some kind of retracement was here. It wasn't very. So I would say that like here, this is more of a better retracement, because you're coming closer again, at least to that small moving average, and this is quite a good spot in a way. Once you have a trend established like this, we've broken the trend line. Once price comes after having been away from it, this is a better spot to potentially buy again. So, so you're waiting. This is what you're waiting for, these pull these movements and then for a pullback. And just simply the main thing to protect yourself against entering at the wrong moment is to draw your horizontal levels. So in this case, if I go slightly, scroll slightly outwards again, we've drawn some resistance levels up here. Now we've also got to think, okay, why did price stop here actually as well? And that's because you can see on the 1 hour chart there is some resistance here as well. So this is why we got that pause here. So if I go back to my my 50-minute chart, I would say that given that this has moved, that averages are aligned and prices pulled back to these moving averages, anywhere here, anywhere within these within the zone of the moving averages could have been an okay buying signal. And in this case, because it's moved quite a lot already, I might not be that generous with my target. I might be in and out quite quickly in this one. So I might, once a price approaches this level again, I would probably put this to break even and possibly take some profits already. I wouldn't be hanging in there too much because this has moved so much that we could get a bigger retracement yet. And this is where your moving averages again come in quite handy. And you've got to gauge it by, for example, how far stretched out they are. Like, so if I'm going a bit too fast here, let me know and I can slow down and explain anything that's not clear exactly. But unless I get any questions, I'll just keep on going and assume that you can follow me. So this was an interesting situation here, you know, because in a way this area would have been a better time to enter on the one hand, because the moving averages are correctly aligned, but they're also not as stretched out as here. And so of course, and you can see we got a good movement. But we also had this trend line still in the way. So it wasn't an easy call here exactly to make. But now that this has broken, it's also important to let this now kind of come back to itself again first. So what I would like to see, for example, here next, instead of, I mean, I said you could, there might be something to trade here, but in a way what I would like to see more is more of a correction first before entering, because we've got this resistance trend line out of the way, we've got room to the upside. Now if, say for example, price comes down here and this red line comes closer to the green line again, maybe down to here, down to this level or so, where there was a slight like a previous support here, something like that, or down to here, that would be more interesting, because once these moving averages come closer together again, this would be a better time to buy. And so it's a bit of a, it's not a hard and fast rule strategy. It's something that you can kind of need to gauge a bit with some of these elements that I've talked about. And it's also, you can, I'm sure, utilize any analysis tools that you are already familiar with. Like, you can really add anything you want to this, which is quite handy. So you can use Fibonacci, if you like to use Fibonacci and say, right, we've had this move, and you can bring this into the equation and say, okay, I'm waiting for a touch of one of the Fibonacci levels in conjunction with moving average or something like that. I'm not going to go into Fibonacci today, but for those of you who do use it, that's an option. You can also, for example, now draw support trend lines, right? So because now we've got this trend line established, let me make this a different color. Maybe make that gold. So you see we've had sort of a touch here and then another touch here. So this is a sort of short-term trend line. And you can see, well, we're starting to get a bit of a sort of what I call an area of convergence, of confluence, where this moving average might come up here, price might come down here. And so this could be somewhere a bouncing spot in this area. So this is kind of more or less how you gauge. I will go through another example as well. And if you want me to look at any particular currency or equity or something, we can do that. Just write that in the chat. Then in terms of targets, I said if the market is trending, then you can just follow this move, and you can say my target, instead of using resistance levels, is when these moving averages, for example, will start to cross. So say this price, just in theory, would start to go up, continue to go up from here. And at some point, price obviously will pause again, and it will come into these moving averages, and they will start to cross. So for example, if I show you somewhere previously in the past, that would be probably easier to show you, sorry. Where are we? Here. Okay. So say, who knows, maybe you took a trend, you took a trade somewhere here, and you've in this move, and so you can decide, okay, I'm going to take profits after a price breaks, closes below that first moving average. That could be one. Or you can say, I'm going to close when the moving averages begin to cross. That's, in a way, it's a more passive way of choosing targets, because by waiting obviously for a retracement to happen before you exit, it means that your exits won't be as optimum. However, you do give the trade more room to potentially go further if you do that. So say if this price, maybe if you say, okay, I'm always exiting when the red crosses over the green, so that when the 20 crosses over the 40, you would have exited somewhere here. But say if this price would have turned a bit earlier, before this crossing happened, then you might have actually caught this whole extra new swing, and it gives you the option to leave price the chance to rise more. If levels like horizontal levels, like I just showed you before, you tend to get better exits in the sense of you tend to catch the tops of moves, but of course it means price might just pause here and then break through it like it did here. So it depends really how you like to do it. It depends if you just want to feel happy with, okay, I've got profits, price is at a peak, I'm happy with it. Maybe I re-enter later again. Or if you just want to, if you're a bit more of a patient trader, I suppose, or maybe not patient, but just more saying, okay, I'm just giving this as much of a chance as I can, at the potential risk, I suppose, that the profits that I had already might get reduced, because if this comes down and comes, I don't know, back down to my entry point or so, then maybe I get stopped out at break even. So that's something you've got to gauge. For yourself. Okay, let me see. There's some questions have come in. Okay, so Wilhelm asked, what about time? Should we consider watch the trade all the time or more in London or New York session? Okay, well, how do I answer that question? Obviously, price moves the most during those two sessions. So during the early hours of the London session, and then after lunch in London is then when New York opens. So those are the two busiest times. So you will get the most movements often then. So in some ways, if you are in the right time zone, this can often be the times to trade where things move most. Usually the Asian session is extremely sleepy. Sometimes you do get movements in it, but they're often, you get a movement and then it just pauses again for half the day until London closes, London opens. So I think it's more to do with planning your trades in advance. I think that's probably the best time. So it doesn't really matter then at what time it happens, because it's more like you want to have a plan already. So say, for example, in this situation here, if I pretend that price was what example can I show you? Okay, well, look, like in this case, obviously I analyzed this trend line, but just for the sake of the example, if we just pretend there is no resistance trend lines that might be a worry for us, and price is about here at the edge of this right screen, then I would already try and have a plan and say, okay, regardless of what time of the day, I know that price has closed above the moving averages and it's crossed over and it's pretty close still. We had a move up and now it's come back. Here we had the first candle close above, fully above the moving averages, and say, okay, so this would be here my entry signal, but you already want to plan based on, in my case, I would use these horizontal support resistance levels. Where's my exit? And where's my stop loss, of course. So, and again, for me, for stop loss, I would use levels, which I will talk about very briefly, but just to answer your question. So I would determine those two things, determine my entry, and then basically let it run. Then you don't have to monitor it initially too much, right? You just have to give it time to do its thing, and basically decide, what happens after that. Once price goes in your favor, at some point you might just want to say, okay, it's gone in my favor. I don't want this to just make a sudden U-turn, especially if it moves well like this. It should really have continuation. And so the only thing I would do is maybe put it to break even, possibly. Once it's moved away far enough. If it's much slower, you might not be able to put it to break even without interfering with the trade. But that's probably all I would do, and try and let it run to my targets, because with these horizontal support and resistance levels, you will encounter them quite frequently. This is really, they often get, you will reach them quite easily. If you want them more in the longer term, if you want to keep them open longer, then yeah, you just have to kind of be present then maybe at certain key points. You have to make sure that what news are maybe scheduled for the currency pairs that you're trading, and maybe also be present for the key times, for the opening times for sure. And then also maybe when things go into lunch breaks in London and in New York, because often then people pause, so a movement happens, and then maybe during lunch a kind of correction happens, and then something else might happen after lunch. So that's okay. The next question. Okay, so there's a couple of questions about the big three indicator itself. So obviously, what strategy trading strategy guides have developed is I'm showing you how to do this manually with the 3 moving averages, but actually the trading strategy guides have developed an indicator that's really handy, because it uses these moving averages, but it gives you a much more easy visual sense of how this works. And let me just show you this quickly. Where are we here? So it basically, that indicator, what it will do, I hope you can see that clear enough. So in this case, the chart is set to these different kinds of candlesticks. That's why it looks a bit funny. But basically what it will do is it will mark out for you once a candle closes above or below the moving averages. So, and it will somehow highlight these fields. So the minute this first candle here, try and make this a bit bigger again. Okay, that's probably better. So the minute price moves above all 3 moving averages, you get an arrow, a green arrow, and you also get the shading changes from the red, which is when price was below it, to green, because this is now an up. And the same happens here. It here changes from green to red as a candle closes below the moving averages. And so this gives you a visual of when these movements happen, when these transitions happen, and when you might want to consider taking a trade. The good thing about the indicator is that this is just one option, one visual way that you can choose. There's many others, which is quite nice. So you can, here for example, I think instead of getting these whole areas that get colored, you get simply these green lines, green and red lines. So it tells you, okay, it's in downtrend mode. Here above the moving averages, it's in uptrend mode, and it shows you that like this. Here you got that same look. Here also it shows you take profit and stop loss zones in, again, this color. So it's much use that strategy, it's really nice as a visual aid, and so that's really cool. And you can choose all of these settings in the options of the indicator, and I'm sure that we'll send you an email with the much more details of how it all works. But I just thought I'll show you this overview so that you get a sense of it. This is another form. Instead of having whole colored areas, you just get these dots that are coloring the area. And so you see what we were talking about, for example, that officially for the strategy, the trend is, so to speak, up because the price is closed above these moving averages. But you can see that it's really only here, or even actually at this point, when all the moving averages are in the right order again. So in a way, I would consider mainly the trend to be established correctly once they have come into the right order, which would be somewhere along here. And then after that point, to wait for retracement here. So yeah, this is basically definitely the indicator that I would use to do this, and I think this PDF comes with the indicator. But yeah, hope that answers that question. If we go back to our charts now and just answer those other questions, if you're going to let it run, wouldn't it be better to use a trailing stop? Okay. Well, that's a good question. I'm personally not such a big fan of trailing stops, actually, because in a way, because of, again, they tend to make you stop out at not the most opportune moment. So because depending on how tight you set your trailing stop, you might get stopped out at just a small pullback when price could have gone further still. And you can, it's just my personal preference that I've sort of come to appreciate the most over my trading time, is for short-term trading. And by short-term, I mean, you know, that the trade concludes within a day or two or something like that, or during the same, you know, within a few hours. I would definitely use the resistance and support and resistance levels because it just optimizes them. If you want to let it run, I would say I would gauge whether to put a trailing stop or not based on the bigger picture. So based on whether how much room there is really to the next significant level. So in this case, for example, the next significant, really, really major level would be up here, the previous high. And so, yeah, you could say I will use a trading stop, but a more generous trading stop, because if you want to let it run to a bigger target, you have to give it room to do its swings. And then, of course, you've got this question of, well, how far away do I put it? It gets a bit tricky. So in some respects, if you want to let a trade run, it's often the best just to put it at break even at some point once price is far enough away, and hope that it will get to the target that you're planning, because otherwise you just are likely to interfere with it too much. If you're not comfortable with potentially losing all these profits again, be clocking up, then I would say exit at these levels, and if not, just be patient and put it to break even. That's my opinion on it. Yeah, that's right. I think Rob, that was Heiken-Ashi candlesticks on that image. which are just simply here. By clicking on that option up here, you get those. All right. Now let's talk briefly about stop loss settings. So you can see here price a bit higher. It's obviously it's very early trading, and it's at this time of the day when really there's so low liquidity that can't really read much into these moves right now. It's only really at I'm in New Zealand, which is why it's 10:49 a.m. It's only really once Tokyo opens that some direction starts to become clear, so between the 2 hours before Tokyo open are pretty useless in a way. Price just, you can't make any judgments on what price is doing during that time. But yeah, let's talk about stops. So if we would have entered at this candle around here, then again, for stops, I would use, you can either use the moving averages themselves. So you can just put the stop below the moving averages, but it's certain situations that useful because it might be too far. Sorry, the moving averages might be too far away, especially the longer term one. But they are a good gauge because when things are trending, they become very relevant. When things are ranging, moving averages are not good. And that's again where you can come back to support levels. So you can see how we had a touch here, and even here in a minor way, we had this candle test that same level again that was tested here as well. So that to me could be an interesting stop loss setting for this trade, and always put it below the line for a bit. So don't put it right at the line. Give it about 5 to 10 pips. Maybe in 10 pips is quite good. And if you want to be more generous, of course, and that's often good, as you know, to give the room some trade, I would definitely put then the last bottom as my ultimate invalidation level. As in, by invalidation level means, okay, definitely don't want to be in this trade anymore because price will be doing something else if we were to really break below there again. So being a bit more on the generous side with your stops is good, as long as your target is far enough away. So I would always recommend to only engage in trades when your target is at least is further away than where you would have to set your stop. So if you feel you would need to set your stop down here, then your target and this stop would be from, say, from this point here would be 66 pips. So your target has to be at least that, and if not a bit more. So this previous resistance that I had marked out, see here, based on these, based on these tops here. Let's get rid of this line briefly. So we can say this might have been the first target, and in this case it would have been okay. So 66 to 74. It's not a super fantastic ratio, and in a way you wouldn't want, in this situation, you wouldn't really want it to come as low as that again, because it's just broken above it, so you don't want them really to come back down. So you may have been able to use this one, this level as your stop, which then of course improves your reward to risk ratio, right? Because now it's 50 to 75, so that's 1.5 to 1. And it's just, of course, always you're trying to aim for trades that have that optimized as much as possible. Okay, so Tokyo opens, I don't know, depends where you are in the world, but Tokyo itself, I think, opens at 9:30. Let me just check that. So in Tokyo time, it opens at 9 a.m. Tokyo time. So wherever you are in the world, that's when it opens. And you tend to usually see some sort of movement, usually some sort of sudden movement happen after 15 minutes of it opening. And you might get, it's very interesting because with the Asian session, you get constantly these sort of false breaks, and it's only very rarely does the move have really follow through. So you get somebody who suddenly buys or sells something, and you think, oh my god, price is really moving in one direction, only for it to just fizzle out after that initial movement, and then it just sits dead in the water for quite some few hours until maybe after lunch again, and that's usually the character of the Asian session. So it's not that great for trading. It's usually good for, in a way, preparing trades. Okay, then next question. So the Big 3 indicator, yes, it does provide guidance on where you should exit trades. If I go back to this thing, let me just try and find a slide. So here it will show you a zone, basically a zone for profit taking potentially. Here, for example, let's use this example here for this uptrend example, because that was really just a correction, I think. So it's showing you this zone of profit taking potential, and if you combine that with some levels, that would be quite a good way of coming up with a good realistic zone for where you want to take profit. Okay, which indicator would I prefer to using with the Big 3, the oscillators or MACD? I prefer, at the moment, I quite like the awesome oscillator myself. So I quite like this one, the awesome oscillator. But that's partially to do with because I trade Elliott waves, and so that's quite an important tool to gauge it. And of course, it's great for using divergence. So this is definitely, I mean, I'm now a slightly more advanced way of doing it, but for people who do use oscillators, this is really good, perfect for gauging whether there's some divergence that's happening in a trend. So here at the moment we don't. So from this move you can see the oscillator created a higher peak here to there, which is still in line with the price. So that's okay, but I'm virtually sure that the next move we will get divergence, because we had a peak, And this is usually, whenever we have a peak, there's usually one more follow through, and then before a bigger correction comes in. So it wouldn't surprise me if price may test this top, may even go slightly above it, and then we'll have a higher high in price, but here in the oscillator it will be lower than this top, and then you start to have this divergence. And once you get that happen, you definitely don't want to jump in anymore. You want then for price to properly retrace. You want this to come all the way down to the zero line and down into the minus area. And so that's just much more advanced. So I won't really clutter your mind with that too much. Yeah, RSI is good too. Obviously, you can gauge divergence with that as well. Is it possible to trade this automatically on Ninja? Unfortunately, I don't know much about Ninja. I haven't used it myself at all, really. But probably one of the team can help you with that question. So either maybe there is somebody in the chat now, or if not, just email them, and they, I'm sure, will be able to answer that question for you. Okay. Yeah, I think this is more or less it. So I think maybe a final comment, it would be to just consider these points of confluence. I think they've become a really important thing for my trading to gauge as reliable pullbacks, as in when there's more than one thing happening. So maybe you've got two moving averages converging in a trend line and so on. Those are usually good spots to enter pullbacks, because, and maybe even there might be even a support level or something here, and then that could be an interesting spot to enter. So the more elements you have come together in the same price area, the better it is, or the more likelihood there is that it will go in your favor. Now, did you want me to look at any other examples, in particular right now? Have you got any other questions? No? Okay. Doesn't seem to be any more questions coming. So yeah, I mean, I think this Euro Aussie dollar is quite an interesting one right now, because of that bigger picture. So I really like the fact that we had this correction break now, and I think there could be some nice room for upside, at least to that top again. The pound US dollar is also now interesting, because clearly we've had this significant break downwards now. So this could be very interesting to trade using this strategy once we get a pullback to the moving averages. And you can see here, for example, you can draw a trend line. You can see price might start to pull back here. Maybe that could be an interesting place to enter. So yeah, keep that in your mind. This is a good one. And yeah, I hope you enjoyed it. I'm not sure it might be for free. I'm not 100% sure myself. I'm more to do with the education side of things, but I'm sure you will get an email, and if not, just go to the website or email them, and you'll get all the information about how much it is or whether it's free. If you signed up already, I'm not quite sure. Great. Okay. Well, sounds good that you enjoyed it, and we'll see you next time again. Thank you. Bye-bye.